Good evening, members. ಎಲ್ಲರಿಗೂ ಶಿವರಾತ್ರಿ ಹಬ್ಬದ ಶುಭಾಶಯಗಳು. So, I see a Vipakshika on behalf of the management committee of Bangalore branch. Welcome you all for this half-day seminar on accounting standards and financial statements for non-corporate entities. We have a learned speaker, CA Mohan R Lavi, who will deliberate on this topic. May I call upon Chairman CA Manjunath Halur to escort the speaker and present him a floral bouquet. Chairman will select accounting standards. Shivan Puja Madaga on standard set ಮಾಡಬೇಕು ಹಂಗೆ ಇವತ್ತಿನ ದಿವಸ has selected this topic so that for all our accounting the standards need to be practiced. So with this I have a privilege to introduce our speaker, CA Mohan R Lavi, the qualified chartered accountant in 1989. He has over 25 years of experience in industry across a variety of industries. He has worked in senior positions in finance and manufacturing and software companies. Mohan also has over 6 years of experience in practice. At present, he is a partner at KP Rao and Co. Chartered Accountants Bangalore and head the AS and GST practices of the firm. Mohan sir is author of books on IFRS, Ind AS, key audit matters and other related topics. Mohan has spoken at various conferences in India and abroad on accounting standards, IFRS, Sarbanes-Oxley and GST, and he is a faculty member of the Institute and the IFRS certification course and registered value programs. His articles appear frequently in Hindu Business Line, Deccan Herald and the Bombay Chartered Accountants Journal, including that of the Institute. With this brief introduction, we present you before you CA Mohan R Lavi. So,
Good evening. First of all, let me thank Bangalore branch, Manjunath in particular, for calling me on a holiday to speak on a topic which may not be the most popular topic in town. But still, I think it is very important that, looking at the participation today, I always felt that there will be two reasons. One is it could be because of Shivratri, or it could be because of the standards itself, or it could be because of CP. It may not necessarily be because of the standards by itself. I always feel that because of the extension in CP, I think many of you are having that balance to be completed. Though Manjunath has got other programs for all of you also, but please stay here because it is important that you complete this and also the other CP requirements or other sessions which are there also. I think the Institute has been doing these programs for, especially on accounting standards and financial statements for NCEs, quite a bit in the last 6 months to 1 year. Actually, they've been doing quite a lot of programs. May not have got the attention which other programs have got, but I think now, because of a few changes which they have made in the guidance note also, this is becoming very, very important. I want to start off by telling you all that accounting standards still exist and will continue to exist. Over the last so many years, we've all been talking about Ind AS accounting standards, IFRS accounting standards. Not many people have actually spoken about accounting standards itself. Our AS1 to AS29 has been there for a very, very long time. It has been there for a very, very long time. And of course, a few standards have got altered in tune with the IFRS and all those things. But a very interesting statistic to tell all of you is that the number of companies in India who actually have to implement Ind AS are only about 28,000 companies. Only about 28,000 companies, say 6,000 listed companies with their subsidiaries, associates, joint ventures. The total population of companies which actually have to implement Ind AS are about 28,000. The number of audits to be done in India, the number of statutory audits to be done in India, I am not counting tax audits and all those things, is approximately around 50 lakh audits. That's the difference. That's the range we are talking about. That's the delta we are talking about here. Therefore, it becomes all the more important for all of us to know that these accounting standards for non-corporate entities are mandatory, number one. Second, there are some exceptions given which we talk about in the course of the presentation today. They are unavoidable also. They are not avoidable. Then you can't avoid them because a company's accounting standard rules which has come into play in 2021. Now, the reason why this is important is because there are a total of about 27 accounting standards which are, as we are speaking today, live accounting standards, or what we call as valid accounting standards, are about 27. AS 1 to 20, AS 29, serial number. You have to remove AS 6 because AS 6 got merged with AS 10 and AS 8 is not there. Because of that, we have a total of 27 accounting standards which are in front of you all, for all of you all to see, all of us to comply with. As I said, it is mandatory because of the company's accounting standards rules 2021, which sort of gave a blessing to these accounting standards because this was the time you should remember when Ind AS also was being amended. So because of that, the company's accounting standard rules, amendments were made to AS 29 and other standards also. Now what happened when Ind AS came, just to give you a bit of a background, was that initially it was a 500 crores net worth, all listed companies, then came down to 250 crores net worth. Banks and insurance companies are still not following Ind AS. So as we are speaking today, companies with a net worth of less than 250 crores do not have to comply with Ind AS. And out of those 50 lakhs companies, a major part is what will be these companies with net worth of 250 crores, the majority of your clients and our clients. These are the companies who mandatory will have to only follow accounting standards and not Ind AS. When Ind AS came in 2015, and it was a gradual roadmap, it was a phased roadmap. They first said listed companies 500 crores, and they said non-banking financial companies, and they slowly rolled out the map to everybody else. Companies below 250 crores net worth, the institute said that we will amend these existing accounting standards and make them almost equal to Ind AS. We will amend the existing accounting standards. They actually put in a bracket called as AS bracket R, AS bracket revised. Drafts were issued. Exposure drafts were also made, but somehow those accounting standards have not seen the light of day for whatever reason, we do not know. But it is good for us because we don't have to reinvent accounting standards in terms of that, going back to IFRS and all those things. However, it may come tomorrow, who knows? It may come tomorrow, the institute may say that it is going to be applicable from, say, 2026 onwards. Because the exposure draft is that it has to be slightly revised. One of the things which I think the ICA has very clearly understood is that Ind AS is not for everybody. Ind AS is not for everybody, in the sense that the complications of Ind AS, many of you who have got some exposure to Ind AS will probably realize what I am saying. Why do you think the Reserve Bank of India has still not implemented Ind AS for banks? What could be the reason? A regulator who is so proactive in regulating the banks, regulator who is so proactive in protecting the foreign currency of the country. You should remember the Reserve Bank of India has hardly allowed any banks to collapse in India. They've always given them off to other banks. No bank in India has actually collapsed as in collapsed. I can give you a few examples. You take a bank in Kerala called as Nedungadi Bank. which was on the verge of collapse. They had a very strange problem because they were based in Kerala. Guys will probably understand what I am saying. Lot of deposits, interest income debit is there, nobody to lend to, no industries to lend to. Heavily leveraged balance sheet it was. The MD decided to invest in the stock market. I need not tell you what happens if you invest in the stock market. So that bank collapsed, it was on the verge of collapse. Reserve Bank of India inspection found severe problems in the working of the bank. RBI said no, I will not allow you to collapse, especially when there were so many depositors in the Gulf. They gave it off to Punjab National Bank. Global Trust Bank, another bank which was definitely probably better if it had collapsed also probably. But by this time, RBI had already scouted and found buyers for various banks. They knew that State Bank of India is going to absorb all the other banks, so they did not want to touch State Bank of India. They looked around. When Global Trust Bank was on the verge of this collapse, they looked around and said, no, don't worry, I will not allow you to collapse. But there were no takers. Punjab National Bank had already taken Nedumedi Bank. Canara Bank had taken Amanat Cooperative Bank. Every bank had already been taken some other bank. But RBI said, no, don't worry, I have a plan. You don't have to always get acquired by a stronger bank. I'll make a weaker bank acquired. They made a bank which was probably weaker than Global Trust Bank called as Oriental Bank of Commerce. They told Oriental Bank, you take over Global Trust Bank. Oriental Bank of Commerce was shocked. They said, what is happening here? How can I take over a person who is stronger than me? But they said, okay, any capital requirements and all those things we'll take care of. The point is that, as all of you will probably be aware, many of you who are doing bank audits will agree with me. If the banks implement Ind AS, two areas which are essential for the functioning of the bank and which are probably most risky also will get severely affected. One will be your provisioning for your, that is what a bank audit is all about, isn't it? It's only about provisioning. Negotiation for provisioning, shall I say? I didn't go to the election by saying negotiation for provisioning. If they implement the ECL model as required by Ind AS, not only should they go by past data, they should also look at what they're going to do in the future. So in the ECL model, which they are slowly trying to implement now in RBI, provisioning will not only become faster, it will become higher also and earlier also. Banks will have to come on with a proper ECL policy. RBI is saying, let us wait, the timing is not good. So they have never implemented Ind AS for the banks. Similarly, the other part of bank which is very, very important, treasury. If the banks have to fair value all their investments in today's stock prices, imagine what is going to happen to the financial statements, both treasury as well as NPA. So RBI is saying, we'll wait and watch, we'll wait and watch. How long they can wait and watch, we do not know, but still, RBI has not implemented Ind AS for banks. So I think that's why Institute also pushed back and said that companies below 250 crores, we will not implement Ind AS. We'll see what happens. Maybe they may not implement Ind AS also, but I would like to put I would like to tell all of you all that in case these accounting standards are revised to make it at par with Ind AS, which I think is going to happen at some point of time in the future, it's an excellent opportunity for all of you all to, it's an excellent practice opportunity, shall I say. 5 years back we thought GST is an excellent practice opportunity. Today it is still a practice opportunity, but we can't say it is lucrative any longer. But if these accounting standards are revised as per, or to make them at par with Ind AS, because see what has happened now is that AS 10 for example is almost on par with the Ind AS standard. AS 29 is 90% Ind AS compliant. So we have standards which are almost at par with Ind AS, but I think at some point of time, hopefully in the near future, ICA will come out with these standards, because what is truly appreciable from the institute's point of view is that when they brought out these exposure drafts, one of the most difficult standards in India is Ind AS 109 on financial instruments. It has not been written by a chartered accountant, it has been written by lawyers only. Because every paragraph there is a cross-reference to some other paragraph. It doesn't flow in one sequence. They say if you want to do this, go to this paragraph, go to do that, come to this paragraph. It's an extremely complex standard to read. When the institute wanted to revise it, they brought out a standard. This is, I don't have the standard with me, but just the exposure draft standard. A standard which had 189 paragraphs, the Ind AS. They brought it down to about 75 or 80 paragraphs in a simple language and simplified the entire standard. All that other comprehensive income, mark-to-market accounting, all those things concepts they completely changed and brought out a very simple exposure draft which was probably, you can say, tuned to the Indian conditions, shall I say. They said one is complicated financial instruments which all the banks will follow, others will follow, the others will be normal people who will follow. There is no need for a fair valuation, continue at cost. Whatever is your present practice, most of it, some of it will be fair valued, but they made out very clear, what you can say, demarking of how financial instruments will be recognized, measured and also valued. But as I said, this is all, we are just talking about what could possibly happen in the future. But as I said, if it comes in, definitely these companies with a net worth of less than 250 crores, significant part of your clients, will not be in the Ind AS roadmap because NFRA also is not going to permit it. They are saying no, we cannot be a part of Ind AS. So we will probably either wait for these revised accounting standards, or worst comes to a situation, if the accounting standards are not revised, these standards will continue. Whatever these standards are, they'll probably continue. But we'll have to wait and see what happens there. Right. 129 bracket 5 is the section which talks about these companies' accounting standards rules. 129.5 of the Companies Act talks about these accounting standards. They have been blessed further by the company's accounting standard rules. So whatever AS 1 to AS 29 you have seen have been given legal blessing because of section 129 bracket 5 there. And of course, as all of you will be aware, at some point of time in the past, the ICA also thought that let's not complicate the standards too much. There are small and medium enterprises, or what you could probably call the typical MSME segment. Let us do further relaxation for them. So what they did was, they built up 4 levels, level 1, level 2, level 3, level 4, and they gave various exemptions depending upon those levels. Now the reason here was that for those MSME entrepreneurs and MSME enterprises, let them not take the trouble of doing the full accounting standards. Let's give them some sort of a relaxation. One statement one standard which stands out here is the AS3 on cash flow statement, which was exempted at various levels. Level 1 was mandatory, level 2, level 3 there was some exemption given for cash flow statement also. But then, even for between level 2 and level 2, level 3 all depend upon turnover, net worth, those criteria. In 2024, the institute thought that, okay, this is getting too complex. Because you can shift between levels in a different year because of the net worth criteria and turnover criteria. Let's make this even more simple. We'll remove these 4 levels. We're only going to have 2 categories now, and that is the reason why this accounting standards for NCEs is becoming very important in today's context. The amendment has come with effect from 1/4/2024, which means that 31st March 2025, we don't have those 4 levels. We only have 2 levels, and for 31st March 25, whatever accounting standards we are going to follow, will have to follow only these 2 levels. So what they have done is they have removed these 4 levels and just made it MSME and large entities. That's it. Within this, there is some exemption which I talk about. That's okay, that's not a problem at all. But you don't have to worry at which level your client is now, because those levels from 1424 have been done away with, and now we only have two categories. One is either you are an MSME or not. Actually, either you are an MSME or you are large entity. This is only for the point of view of accounting standards. Please don't worry about MSME Act and all those things. That is a separate situation by itself. This is only for the purposes of compliance with the company's accounting standard rules. You categorize your clientele now into two categories: MSME, non-MSME. Non-MSME you can call large entities also, does not really matter. The criteria for MSME is very simple. You don't have a listing either in India or abroad. Don't plan to go for a listing either in India or abroad. You are not a bank, financial institution or an insurance company. Turnover is less than 250 crores in the immediately preceding accounting year. Borrowing is less than 50 crores. And it's not a holding company or a subsidiary company of a non-MSME, or it's not a holding or subsidiary company of a large entity which is not an MSME company. This presentation will be there in the institute, or can take this presentation at some point of time. It will probably also come on the portal also. But please keep this at the back of your mind. Two very important criteria are turnover which is less than 250 crores. The 1000 crores has gone away now. It's turnover less than 250 crores. Borrowing less than 50 crores. In the immediately preceding accounting year, they have not said financial year. I don't know what that purpose of that is, but let us assume that financial year and accounting year are the same. Let's not get complications in what that could possibly mean. Now, if your client is following or is coming under this particular category, Companies Accounting Standard Rules 2021, the circular which I showed you becomes mandatory. Those accounting standards become mandatory. There is no escape from those accounting standards, so you will have to follow those particular set of accounting standards now. So it is possible that, let us say in the previous financial year, you were at level 4. Your client was at level 4. You did some relaxations given by the accounting standards. So now you will have to probably sort of work back and see which, there's no question of which level now. You only have to see whether he's an MSME or non-MSME. And please remember that this criteria or this benchmark is applicable from 31st March 2024. Applicability is 1424, but the threshold, turnover and your borrowings is as on 31st March 2024. Now, many people have already started raising questions here. Many people have said, what if the borrowing was higher during the year, but end of the year it was lesser than 50 crores? What happens in those particular cases? During the year it was 75 crores. On 31st March I made it 50 crores. Should I still follow this accounting standard rules or not? What do I do? So all those things I think are points which can always be discussed, but I think that if you look at the wording saying in the immediately preceding accounting year, it does not say as on. It says in the accounting year. So I would believe that at any point of time, if it has crossed this threshold, you will have to follow this. It becomes an MSM enterprise. So you will have to follow these particular accounting standards. So there is no, sort of ambiguity as far as applicability is concerned. Anytime during the year, you will have to follow this particular thing. Again, many people have asked, turnover is it revenue from operations? Does it include other income also? Okay, so these are, does it include GST turnover? Or should it match with GST turnover? I don't have the instant answers to all those things. But generally, turnover means revenue from operations, does not include other income. The general nomenclature is revenue from operations only. So if the revenue from operations is less than 250 crores, it will be applicable. Please keep this in the back of your mind, because of one important thing which the Institute has mentioned in the guidance note. Later on I'll talk a little bit about the guidance note also, because the Institute has come out with a guidance note on financial statements of NCEs. Immediately you know what we are going to say, it's only a guidance note, it's not mandatory. Well, should I follow it? Should I follow it? What if I don't follow it? All these discussion points will definitely come. I think that the guidance note is only for the purpose of guidance. That is very, very clear. Any guidance note is only for the purpose of guidance. But then, imagine what will happen if you don't have the guidance note. Do not have any guidance at all, right? I still remember that AS7, for example, revenue from construction contracts. It said that POC method is mandatory. You have to follow the POC method, percentage of completion method. But the standard did not say, when do I commence it? It said to do the POC method. It has to be done. But did not give guidance, when do I commence it? Should I commence it when 10% is complete, or majority is complete, or when it is possession is handed over? When do I commence the POC method? The ICA realized this. They brought out a guidance note called as Guidance Note on Real Estate Transactions, and said that if your construction is 25% complete, 10% of total number of units have been sold and revenue has also been received from them to the extent of 10%, you can start your POC method. Till that time, account for the cost, account for the revenue without any profit element. This was a very well written guidance not given by the ICA. They said that 25% of construction is your threshold. If you cross 25%, start POC method. Till 25%, what you should do? Only continue your cost versus revenue, no profit to be booked. Everybody said it's only a guidance note. It is not mandatory. Why should I follow it? Should I follow it? Is it an accounting standard? All these questions came up. Some companies somewhere in India said that in their annual report or in their financial statements, I think they said that this guidance note is very, very useful. We are following it. The moment that first company followed it, what happened? Everybody started following it. We are always waiting for the first person to make that mistake, shall I say. I won't say make that mistake, to follow this. It happens in all the cases, even your disclosure for, voluntary disclosure for assets and all those things. Everything will be ready. We will not wait for somebody else to file it. See what happens, then we file it. Over a period of time, what happened? The guidance note became even more important than the accounting standard. People started saying, what a beautiful guidance note this is, we follow this only. They forgot the POC method. Given the standard, they said as per guidance note issued by Institute of Chartered Accountants of India. So why I am saying this is because guidance note may not be mandatory, but in the absence of a guidance note, we probably don't know what is to be done. That's why this guidance note on non-corporate entities also becomes very important. I'm quite sure that over a period of time, this guidance note also will take the form of a guidance note on real estate transactions only. Okay, so non-MSME, that category has been done, right? Okay, now the other thing which we have to also worry about is that, I think it's not sure, but just a minute. Okay. Right. What is not applicable to all the MSMEs is AS3 on cash flow statement. I'll talk a little bit about that. AS17 segment reporting and AS24 on discontinued operations. Institute has felt that not required. But I want to sort of AS3 cash flow statement not required, segment reporting not required, discontinued operations not required. Discontinuing operations was the word, now it has become discontinued. It's more after the event is over. I want to emphasize to all of you all, though this exemption is there, I'm sure we'll avail this exemption. Importance of cash flow statement. The importance of the cash flow statement. In fact, I personally feel that this is one statement which has been, what should I say, not given the importance it actually deserves. For the company, as long as the cash flow statement tallies, job is done. For the accountant, CFO, whoever it will be, as long as the cash flow statement tallies, he feels his job is done. That would not have tallied. There is one beautiful thing called as changes in working capital, which is basically the difference between two balance sheets. So somewhere he would have adjusted the previous year's figure there, got the current year's figure. Something would have happened anyway. As I said, since the importance is not there, we don't worry about it too much. But I thought I should inform you all about this because we are talking about MSMEs and the cash flow statement. Nowadays what is happening is that cash flow statement is becoming a tool for actually analyzing the financial statements more than the balance sheet of the P&L account. More than the balance sheet of the P&L account. Though it may be too, what we can say, not the right example to give, but you look at a person like Warren Buffett. He's got some criteria. Most of it is the cash flow. How much of cash does the entity generate? Is your operating cash flow positive or not? He invests only based on the criteria. So over time, what many people have done is that they have developed a sort of a formula where they are saying, analyze the cash flow statement. If the operating cash flow is almost equal to the financing or the investing cash flow, this is a stable company. Stable means what? Going concern, not gone concern. This is what many people have given the interpretation. Even though there is a exemption for MSMEs from preparing the cash flow statement, and I am sure that once an exemption is given, what we will do? We will definitely take it up. There is no doubt about it. I am talking about it purely from the point of view of analysis. You forget about accounting standards. Purely from the point of view of analysis, it makes a lot of sense to actually analyze the cash flow and see whether there are any inherent problems. The concept of going concern will not come from your balance sheet or P&L account. The concept of going concern, even if you want to qualify as per the essay, will come only from your cash flow statement. A cash flow statement analysis over 2 or 3 years will give you a very good visibility as to whether actually the concern is going concern. Because continuous negative operating cash flows is an obvious red flag with no negative financing or investing cash flows over the past 2 or 3 years. So even though this is not there, I am saying that don't have to publish it from the point of view of accounting standards, but just for the purpose of analysis. You may want to look at the cash flow and ask and do a sort of analysis to see what is there. See, segment reporting, we understand that most of these MSMEs are probably going to be in 1 or 2 segments. So the institute has probably thought it fit that we don't have a separate, accounting channel has to be followed separately. 24 discontinued operations already coming in your schedule 3 itself. Separately, are showing the financial results, the profit from discontinued operations coming separately. So why do you want to have a separate accounting channel for? This is what they have felt. So I think these 3 exemptions have been given for all MSMEs, so you can sort of follow those these things here. Right. AS 18, related party disclosures, AS 28, requirement of assets not applicable to the entire MSEs of a particular category. Turnover 50 crores, borrowing 10 crores. For them, the partial relaxation has been given. They don't have to give the disclosure of related parties as well as impairment of assets. Now, okay, this is there again, partial relaxation is there. So below 50 crores turnover and below 10 crores borrowing, they don't have to follow AS 18 on related party disclosures, don't have to do impairment of assets. Again, 2 very, very important standards. Exemption has been given. You just take a look right from Satyam up to ILFS and Divan Housing. All of these, what I call as accounting accidents, people call it fraud, I call it as accounting accidents. It's a nicer way to put it. All of these accounting accidents, what was the common theme? Every single one of them had transactions with related parties. The advantage of a related party transaction is its sheer convenience. I don't have to worry about anything with a related party transaction. It's all internalized only. It's very convenient to do a related party transactions. When the pandemic struck and when there was a lockdown, 24th or 25th of that particular month of March, whichever year it was, banking industry was shut, companies were shut. But some companies had to sort of make some payments, make some transactions. Didn't have access to bank. What do? They said, okay, I've got a subsidiary company. That subsidiary company seems to be having some excess cash. I will borrow from the subsidiary company, and after the pandemic is over, after lockdown has been lifted, I will repay it back. I know of enterprises where this has been done during the pandemic. That loan has still not been paid back. It is still remaining in the books as a loan. Sheer convenience. The convenience of related party transactions is also its biggest weakness. The convenience of a related party transaction is also its biggest weakness, because what is going to happen is that even audit committees nowadays, they do omnibus approval. They say 10 crores during the year, do any related party transaction. It's an omnibus approval. I don't have to do a ratification every single time. It becomes very convenient. But I would assume that all of those things, all of the examples which I spoke about, are still only an exception. Related party transactions, by definition, are not wrong, as long as they are done at arm's length price and there is an appropriate disclosure. That's all is required by both the AAS, Ind AS as well as SEBI, Companies Act. Everybody requires only this. All they are saying is do the transaction at an arm's length price and ensure that there is an appropriate disclosure, not only of the transaction per se, but who is the related party, what is the sort of transaction thing. But for certain MSMEs, Institute has thought it fit and said that we may not do a related party disclosure because specific exemption is given if a turnover is below 50 crores or below 10 crores worth of borrowing. Please remember, now you have to have an Excel sheet. MSME, non-MSME, one Excel sheet. Then below 50 crores, below 10 crores, exemption from AS, related party transactions, as well as on the impairment of assets. Similarly, on impairment of assets. See, AS 28 is, as I said, almost on par with the Ind AS standard. All of us know how, we all know how audits are being, we go on the basis of what is called as checklist. Right? For every audit, we have got a checklist. Right? To take, for example, the checklist for Caro. What will be the first question in the checklist? Caro checklist. Fixed assets. Does the company have got physical verification of fixed assets? What will be the response? See, already you are saying yes, I have not even seen the register. Some complicated document will be shown in different colors. They will say, okay, yes. Physical verification done. No major variation from the physical thing. Title deeds, the new one has come in the Companies Act. No title deeds of property. That also they will say, okay, apart from some land and name of the promoter, all the rest title deeds are name of the company. One question which should be there in the Caro checklist, and it is not there because it is not there in the Caro itself, is has the company tested any of these assets for impairment? That is not there in the Caro questionnaire. Because it is not there in the questionnaire, it will not come in my checklist. Because it will not come in my checklist, the question will never be asked. If the question is never asked, it will never be answered also. So what will happen is that it is possible that an impairment may actually go unnoticed because of this situation we have got. See, impairment, especially under the accounting standards today, apart from impairment of goodwill, which cannot be reversed, all other impairment can be reversed. It's like a current account. What is important in impairment is the timing of the impairment, not the calculation. The calculation is very simple. Recoverable value, carrying amount, whatever is higher. If the carrying value is higher, it's impairment loss. Next year, if it is more, you reverse the transaction, no problem at all. But what is very, very important is the timing of the impairment loss. So every single year, you will have to test for indicators of impairment. Indicators of impairment could flow from the financials, could flow from production records, non-production records, any of these factors. But once the indicator impairment has been seen to be existing, then you can calculate what is the impairment loss. If it is not a goodwill impairment loss, you can always revise this later on subsequent year if you feel things have improved. So this exemption has also been given for two very, very important standards. Even for related party transactions, I would believe that the most popular related party transactions we know are holding company, subsidiary company, joint venture, KMP. Every company, this is our related party, invariably. For most of the entities, this is a related party. But there can be some people who still have got influence, but are relatives of the promoters or KMP. They could also technically form a related party. So even for related party, I can give you an example. Recently in some places was happening, there was a SAP implementation going on. And since we knew the company well, we knew the CFO and the other accounting members, and they wanted the auditors to come for the SAP kickoff meeting. So we went there. We found a new person there, and we did not know who he was. He was not introduced to us also, but he seemed to be taking a lot of decisions on his own. He used to say, "No, this is what we are doing. We are implementing in this module first and all." So he seemed to be having power over the implementation of SAP. So after the meeting was over, I asked the CFO, who's this person? He said, he's the son-in-law of our MD. And I said, okay, then you should probably become a related party. Then he said, no, why is he a related party? I said, he's influencing everything on SAP implementation, which is very critical for your enterprise. You're paying him a salary, then he says, not an employee, he's paying consulting fees. Even more. Even more reason why you should probably be a related party. So there can be situations wherein this word called as significant influence has to be tested completely. So again, identification, once identified, then you have got the issues of implementation in terms of relaxation, whatever you want to do in terms of arm's length and all those things. What the ICA has also done is that they know that companies who are in those various levels had availed those exemptions given for level 2, level 3, level 4. Level 1 there was anyhow no exemption. So what they did was, they said, okay, doesn't matter. We will continue those relaxations even for those MSME enterprises. Whatever specific relaxations that are given for level 2, level 3, level 4, those relaxations they are continued. For example, you look at what has happened here. The carrying amount of temporarily idle property, plant and equipment disclosure required as per AS 10, they are saying not required now. For MSME enterprises, don't show it. Fully depreciated assets, nominal value 1 rupee standing in the books of account. Those also don't disclose. And the revalue amount, that particular exemption also has been given. Retired from active use and not held for disposal. All these exemptions are also being continued. We'll come to this reason for this little bit later on. But you look at the reason for this, they seem to be saying that for an MSME enterprise, fixed assets can constitute a significant portion of the MSME enterprise's financial statements. Our normal requirement from the point of view of fixed assets is what? Capturing the cost, any revaluation has been done, useful life, depreciation. Useful life, normally you will say companies are scheduled to. Unless there is a reason for you to believe that the useful life is different. See, when the Companies Act Schedule 2 was first drafted, when the draft came, they said these are indicative useful lives. Before it was actually published, they used the word saying that it was indicative useful life. MCA is aware of what will happen in the Indian situation. So they said that if you give Indian companies the word called as indicative, what will they do? What's that? I will look at my total profit, I look at my tax paid, I'll not charge my depreciation entry, I'll change my useful life according to what I wanted. So they said this word called indicative useful life, which is an IFRS terminology incidentally. Indicative useful life means these are only indicators. If you feel that your asset is depreciating faster or is going to depreciate slower, you can change the useful life. That freedom is given to you. MCA told institute that don't do this, don't put the word called indicator because people can change the useful life every year. So now what they are saying, useful life will normally not be different. Which means that in schedule 2, if I have to follow a different useful life, I should have a technical assessment saying that actually this is my reason why my useful life is not what is there in schedule 2. I'll give you an example for this. You take for example Dish TV. There are set-top boxes. 7 years as per schedule 2, 8 years as per schedule 2 I think. Set-top boxes of Dish TV. Tata Sky came into the picture, Jio came into the picture, there was severe competition. Dish TV told in the annual report that all my customers at the end of 3 years either stop Dish TV service completely or go to some other service provider. Which means my useful life is not more than 3 years. Schedule 2 may say 7 years or 8 years. But most of my customers, they gave statistics saying that 80% of my customers do not renew their set-top boxes at the end of 3 years. Therefore, my useful life is only 3 years and not 8 years. So the word called normally not be different in the companies like Schedule 2 means that there should be some indicators for me to say that I am having a different useful life. Even in Volkswagen, for example, I don't remember the brand of the car, but in Germany, I remember this very clearly. They started online bookings for a particular car model under the assumption that they will produce about 200,000 cars per year. That was their estimate. Online booking for some car. I think the car is there in India also. I don't remember the brand name. Anyway, they opened online booking and said that 200,000 cars per year, please open, I'll open for online booking. Within 1 week, they had 500,000 bookings. Or about more than 500,000, 600,000 bookings. Which means that the last person who booked had to wait for 3 years to get his car. So what Volkswagen, they said, if this is such a popular model, we will stop assembly line for the remaining models, we will only push this particular model. Assembly line depreciation became faster then. Because they said that useful life will be 10 years as per Companies Act, but here I am doing it faster because it is being used in multiple shift, triple shift and all those things. Therefore, so even today, if your useful life is different, you should have indicators to say that though that asset is being used faster and therefore the useful life is different. These exemptions for MSMEs are only for fully depreciated assets. You don't have to disclose them. See, one of the things in IFRS, which is what all these standards are also talking about now, is that apart from the accounting and fair value and all those things, IFRS has specialized, or Ind AS rather, has focused a lot on disclosures. They are focusing a lot on disclosures. In fact, the disclosures are extremely intense in Ind AS standards. So obviously the ICA has thought that for an MSME, it may not be practicable to give so much of disclosure. So therefore, if you have idle plant, not used plant, fully depreciated plant and equipment plant industry, don't give a disclosure there. Now the question will arise that if I want, can I give? I think in the present day and age, better not to give because you don't know who's going to ask what question. So if an exemption is there, please avail the exemption. You don't have to give it, means don't have to give it as far as this thing is concerned. Now the other thing which also MSMEs had a problem with, and this came because of a lot of issues in this foreign exchange transactions, AS11. See, if you remember, AS11, there are two paragraphs, paragraph 46 and 46A. For this long-term foreign currency and monetary items, translation differences. You could put it into exchange, you could put it into a reserve account. You could put it into a foreign exchange reserve account and it would be capitalized basically. Basically be capitalized. But what the standard also said was that if you are going to do a capitalization, if you are taking a forward cover, if you are doing a long-term currency borrowing, if you are doing a hedging transaction, you have to give your risk management policy. ICA has also thought it fit that for an MSME may be having, they may have forward transactions, they may have forward calls, they may have derivatives, I'm not saying no. But there is no need for you to give your risk management policy. Whenever you all have the time, I would suggest to all of you, look at, for example, India's financial statements. You look at the risk management policies of many companies. Don't do too many companies, 2 or 3 companies. Just take that India's 109, take the risk management policy of those companies. What will you find there? You will find that the language used is almost similar. It is not entity specific. India is just entity specific. But you will find that most of the language used is similar because if I have to keep on disclosing the risk management policy, and this is every year incidentally, this is every year you have to introduce, so there could be small changes. You could have probably done a forward transaction only one time, not done it subsequently and all those things. Standard is saying here now, they are saying that foreign currency transactions, accounting you do as per AS 11, no doubt at all. You may have para 46, 46A, you may want to capitalize it, long-term currency, all that you can do. But no need for you to disclose a risk management policy. That's what they have given as part of an exemption. This exemption incidentally is a new one. It was not there for level 1, level 2, level 3, level 4. It's a new exemption given, so you don't have to document your risk management policy as per the AS level standard. Okay, now this is one standard which all of you all have obviously worked a lot on, AS 15. I'm sure all of you all know this particular standard by heart now. This is more a disclosure standard than an accounting standard. AS 15 is, of course, it does talk about short term, long term and all those things, but major part of the standard is only about disclosure. And most of the disclosures as per AS 15 come from your actual. I'm sure that all of you have received actual evaluation reports in the course of your audit. Received, sir? Actual evaluation report. You got, no? Very good. Have you read the report? It's okay, you can say yes, no problem. Because you have obviously done accounting as per that, whatever the gratuity provision, all those things as per that you have done. If I ask this question, have you read the report? Everybody says yes. Have you understood what he is saying? We don't. Most of the times, and it's an honest answer. Not many people really understand because it's actually is a separate provision by itself. But what is he trying to say here? What he is trying to say is basically 2 things. One is, what is the provision you have to make for gratuity and leave encashment? Number 1. Second, in case you are funding that gratuity scheme through an investment, whether you have to make additional investments and what is the notional losses or gains from that particular investment. That's all he's trying to say. All the disclosures only work on that basis only. Now this standard, AS 15, which is 95% of Ind AS now, talking about Ind AS is very mandatory. You have to do a actual evaluation. Even the method has been specified in Ind AS standard 19. Projected credit method is what they are saying. But what ICA has thought is that for these MSME enterprises, for leave encashment, especially non-vested leave means leave which cannot be encashed. There is no need for you to make an actual evaluation. If you want to make a provision for that, for leave encashment, make it on any basis you feel appropriate. I think accounting standards have given this word called as reasonable assurance, reasonable certainty, and reliable estimate. All these 3 words flow from accounting standards. If you can make a reliable estimate of the leave encashment you have to provide for, please do it. Don't go to an actuary. It is an extremely important relaxation given particularly for MSMEs in the AS 15. Similarly, anything which is beyond 1 year in days you have to discount now. They are saying don't discount it. Major relaxation given. Suppose you have, let us say some of these provisions can probably be payable beyond 1 year. You could have a long-term scheme which is payable beyond 1 year. discount the present value requirement as per Ind AS. This exemption has been given. You don't have to do it here. So you can just show it at whatever value is there. Those notional finance costs, all those things don't have to be given, right? Okay. This is just one example we'll give. Again, some exemptions have been given here. So I'll tell you about AS 28 because we're talking, then we'll come back to this. Value in use, impairment I told you about. They are saying that value in use, which is normally based on your free cash flows, don't have to do all of those things. They're just saying that value in use, if you are able to make a reasonable estimate, which invariably means fair value, do fair value, don't have to do value, that discounting, the calculation is not required. Very simple, this thing here is required only for the purpose of this AS 28 on impairment of assets. So basically what will happen is how this relaxation has been introduced is that, suppose I have got an asset which I am assuming is now met the indicators of impairment, in the sense that those cash flows are not coming from that particular asset. Asset has been idle for a long time, not been used. I know it's been depreciating still, but there's some carrying amount. But the carrying amount is more than what I can expect from the sale of the asset. I don't have to do present value technique to aside and to get that value in use and all. I can just get a quotation for what is the fair value. Once I get the fair value and the recoverable value is amount, that amount becomes my impairment loss. So the reason why the ICA has thought this fit is because many a time we have seen that the discounting rate can actually change impairment losses or not. The discounting rate used can completely change whether it is an impairment loss or not. It has happened in many circumstances wherein discounting rate has been used differently, and they are saying there is no impairment because value in use is higher. Carrying amount is lower here. But here they are saying that for MSMEs you don't have to worry about this here. Just do a reasonable estimate. Again, the important thing to realize here is that MSMEs can say, I know what is the fair value. MSMEs can say, I know what is the fair value. That machine which is there, I know what is the fair value. I've got one quotation. Please remember that it need not actually be sold. It need not be sold. It's only for the purpose of valuation. You don't have to actually sell it there. So one of the things which we really have to give to the ICAI is the fact that they've thought of all of these standards and then said that, okay, for MSMEs, we'll give this relaxation, that relaxation. One last thing I will tell you all about AS 29, provisions, contingent liabilities. As per the standard, opening balance, movement during the year, which means provisions created during the year, provisions reversed during the year, and the closing balance, we are supposed to give a tabular reconciliation. A tabular reconciliation has to be given. What is my opening balance of provision? What is the amount which has been added to the provision during the year? What is the amount reversed during the year? And what is the closing balance? Obviously, the closing balance will have to tally with the closing balance of provision in the balance sheet. That I need not tell you, right? MSMEs, they are saying that follow the standard, don't give the reco. Follow the standard, tabular reconciliation not required. Similarly, description of obligation, uncertainties and reimbursements need not be disclosed. We always have this challenge, and now after GST, we are further having this challenge. The accounting world is still not decided on this particular issue, but I will give you all this example. Let us see what your response is. I've already given you the catchword of GST. You take a company like Amazon, right? And they onboard their vendors. They have various vendors which they are onboarding. When Amazon first started, they said, we'll ask the vendor to give his products photographs. There's a specification for the photograph. They have to give 4 or 5 different types of photographs. Certain quality was required to be met. So whatever is in the website, whatever is in the app, whatever is in the Amazon app is because it has met certain standards which have been set by Amazon globally. Met by Amazon globally. So you just can't take a photograph on your photo and mobile and send it and it will not be because there's a certain quality maintained. Initially Amazon was not charging anything. Later on, Amazon saw that there are so many, especially in the Indian context, there are so many vendors coming on board. They were incurring a very huge advertising cost only for these photographs. Only for these photographs. So they told these people saying that in case you are giving your photographs as per our quality, whatever the photographer charges, you pay it. It's a back-to-back reimbursement. So if he charges you 10,000 rupees for your photographs, for your mobile phone is coming on the app, I will charge you 10,000 rupees, you pay me 10,000 rupees. So this they started, after about 4 or 5 years after getting this particular thing. So now in the financial statements, you have a very interesting scenario. You will have photography charges of 1 lakh of rupees debit to the P&L account. You will have photography income of 1 lakh of rupees, which is reimbursements basically. The question which everybody has been grappling with is that, should I net it off or show it separately? What will you all do? You want to net it off or show it separately?
So avoid GST.
See, I knew this answer was going to come. I knew this will come in. That's why I said GST itself. If it is a back-to-back reimbursement, now if I go by the concept of income, definition of revenue, the definition says revenue is what has been earned in the normal activities of an enterprise. Amazon is saying my main job is not advertising. My main job is e-commerce. A part of it is advertising. May integrate to it and all those things different, but it's only a part of it. So sir said that to avoid GST he will show it as net, which I think is a very reasonable explanation, because nowadays, I did not tell you about GST. The GST department will tax even expenditure now.
Even on reimbursement.
Reimbursement also, they will tax twice. They will say you incurred, that also you pay GST, reverse tax they will say. You never know. For that matter, not show the accounts, you have to show the accounts. But strictly by an accounting term. In fact, one of these questions, right now we have placed before the Expert Advisory Committee of Institute and asked them this question saying that, if it is a back-to-back reimbursement, no profit element, not my main course of activity, can I net it off? Can I show it net? We are still waiting for the response here, so it could only come at some point of time. Now, strictly speaking, if you leave the GST aside apart also for a moment, do not worry about GST also. I have actually not earned any revenue from that transaction. If Amazon is adding a margin to it, completely different picture. No problem at all. If Amazon is adding even a 5% margin, it is revenue, you have to show it separately, there is no question about it at all. But if it's a back-to-back reimbursement, opinion is now divided on whether I have to show it as net or not. The global practice, in fact even Amazon in the US has been showing it net only. Amazon in the US has also been showing it net. They are not showing it separately because they are saying that this is a completely, service tax has this brilliant concept of pure agent. I'm using it only as a pure agent. I'm not making any money from this, so I'm going to show it net at all. US GAAP permits it. IFRS, we do not know. Ind AS also we do not know because it's based on IFRS. Same concept you can probably take in AS also. But I would think that not only for the purpose of GST, for other purposes also, if it's purely a back-to-back reimbursement, no profit element is involved, not a normal course of activities, I would still say that probably showing it as net is a better way to go about it, considering all the entire other factors also which we have been discussing here. Now what they are saying here is that for MSMEs very good exemption has been given. Non-MSMEs, if you have a reimbursement, you have to disclose it. MSMEs don't even have to disclose. So not only are you showing in net, you're also not going to disclose it, so it gives you a further protection, shall I say, from any of these people who are trying to ask you questions about what, because see sometimes what happens in these disclosures, we tend to give information which others can pick up. We spoke about GST department. What is this reimbursement? Okay, where is this? That is income. Straight away they will say, even though it is not a part of my financial statements, even though it's shown as net in my financial statements. So I think the fact that what is the obligation, what is the reimbursement, uncertainties regarding that provision also, that also need not have to be disclosed. See, this question of provision, again something which is very, we all like the word called provision a lot, right? Current obligation from past events, definition of a provision. If the amount is certain, it's a liability, amount is uncertain, it's a provision. This is a pure accounting standard definition. Current obligation from past event, if the amount is certain, it's a liability, amount is not certain, it is a provision because I'm making a reliable estimate. Possible obligation from past event is a contingent liability. Accounting standards are very clear. So many people have now started asking this question. Why do you call it provision for audit fees? Auditor is certain, fees is certain, auditor is liability also, strictly speaking yes. Literally also liability sometimes, till he gives his report. So why do you call it provision for audit fees? Because the auditor is certain, amount is certain, there is no doubt about the amount. Strictly going by the accounting standard, AS 29 also should not be called as provision for audit fees. Audit fees should be shown as a liability. But then, this debate happened globally. IFRS, they said that you should provide for, again, they went strictly by the definition. Current obligation from past event. What is the past event? Not the engagement letter. The work done by the auditor. IFRS said that provide for audit fees based on the work done by the auditor. In case you have not done any work, don't provide. Who was objected to this? The auditors themselves. All the large audit firms objected and told the IASB that how can you say this provision, how can you make this provision? You are allowing a company to actually provide for electricity charges, not for audit fees. IASB said the light was burning, you are not burning. You didn't do any work. On the basis of work done, you do. So it came to India. The same discussion came to India. We had a very simple response. That's why sometimes you should always ask for solutions from Indian chartered accountants. We had a very simple example. He said statutory audit is an obligation as per the Companies Act. It's an obligation as per the Companies Act. I am not making a provision based on any non-statutory thing. Because this is a statutory obligation as per Companies Act, I am forced to provide for it. The past event is the obligation itself, in which the audit itself becomes an obligation. Amount is certain, yes, on that basis the authority is provision of audit fees. But strictly speaking, if you look at it, going by the accounting definition, you would have to provide based on work done with the auditor. But anyway, since anyhow most of us are following cash based account, does not really matter from our point of view. But from the company's point of view, we have this problem always. Anyway, this sort of a discussion is there on this particular thing. Okay, and then there's something about consolidated financial statements and all those things. Basically, accounting amalgamations, jointly controlled operations. The institute seems to be feeling that MSMEs may not be having their transactions. I would probably tend to disagree there because a lot of M&A transactions are happening in the MSME space now. A lot of M&A transactions are happening in the MSME space, so they may have to follow AS 14 for many of those transactions there. Even for investments also, you may have to follow AS 13. But anyway, the exemption is there. But the provision also says that if there are any such transactions, you will have to apply the requirements of the particular standard. So you have an exemption because again they are feeling that MSME enterprises may not get into what you can say M&A transactions as frequently as other business enterprises. So therefore, if there are transactions, follow the standards, don't follow the standard, they get it. So again, all this 21 consolidation, investments and all control entities and all those things are very much a part of this particular literature. Now again here, interim financial reporting, very important exemption. Again, we also felt that when does an MSME enterprise normally prepare the financial statements? End of the financial year. Who prepares the financial statements? Okay, I'm not going to answer the question, you can answer this. Okay, once in a year, end of the financial year, financial statements are prepared. Let's leave it aside who's preparing it for a moment. Correct? Why interim financial statements? You may require to give something to the bank, MIS information to the bank for your bank forms and all those things. That is separate. There was a requirement a long time back, very long time back. Banks used to tell the companies, please give pro forma balance sheet. They give pro forma balance sheet. So we used to give pro forma balance sheet and say as per information supplied by management, not even as per books of account. We used to say as per information given by the management. So we used to give those pro forma balance sheets. Interim financial reporting, very important exemption given because we may not require to prepare it. Generally speaking, the concept of interim financial reporting appears to be only for publishing that outside. If you are publishing to the outside world like you do for your SEBI requirement or LODR requirements, then we understand the requirement for an interim financial reporting. But then, if it is not required or it's not going to the outside public or the users of financial statements as we say, I don't think we need to prepare it. That's why they have given an exemption even from that interim financial report. Okay. One question which I have for all of you is, you've seen all of these exemptions. The question generally is going to be that, should we really split so much of hair on this? MSME, that paragraph, exemption, this exemption. Should we really split so much of hair? Why can't we just say that, follow it? I'm not telling this in a negative manner, but I think, as this is purely from a positive point of view, there is no law in India which Indian Chartered Accountants are not able to comply with. I'm quite sure of that. You can talk about GST, you can talk about new income tax bill, whatever it is. Let it come in whatever form it is. I'm sure that we'll be able to comply with it. I remember this very clearly when large public sector undertaking, we were doing this Ind AS requirement. Had many branches, based in Bangalore, but had many branches across the country. And CFO says, Mohan sir, our people, they don't know anything about Ind AS, you have to train them a lot. So give video conferences, come there, come to our office, we do 3 or 4 video calls with all of them. So we went almost for about 4 or 5 days. 4 or 5 days we went and gave them various video conferences, different standards, 109, this, that and all. Under the assumption that they have understood. But the assumption they have understood. So 5th day was a feedback form. We asked them to understand, nobody understood anything. They said, no, sir, we don't know what is this value, business value, you are saying you don't understand, business model, and nothing they understood. So I told the CFO, sir, what is this? So much of time we have spent. And he said, Mohan sir, I understand, it is my mistake. Don't worry about it. I'll make them understand. How sir? See, our people are used to filling up forms. You give them one form, you see how quickly they will understand. So what he said was, for these various Ind AS standards, you just give one, not even a checklist, he called it form only. He said they are used to filling up GST forms, they are used to fill up so many forms. The same thing what you said over 5 days, give it in the form of a form and see how fast the response comes. You will not believe, it actually worked. We gave them the same thing which was required in the form of a form saying that, have you got any fixed assets which are available for sale, about to sold? Yes, we have got. They mentioned the asset number also, which was previously not told in the video conference at all. We did not even know the assets were there. But we got this here. Why I am saying this is because when you comply with these accounting standards, especially these non-corporate entities, I mean, look at what are the exemptions given. only in the form of disclosure requirements. Please remember that not much of, apart from cash flow, discounted operation segment, I don't have exemption from the standard itself. I only have an exemption from a disclosure requirement. So is it really required is a question which I am parking with all of you all. In my opinion, not required. You give it to us, we'll comply with it. I think that is something which we have proved beyond doubt in many areas of operations. But again, as I said, maybe this is something which institutes always felt that some relaxations are always required there. Because see, especially if you're going to revise the accounting standards as per Ind AS, then these exemptions are definitely not required because they will be almost on par with the Ind AS standards. So these exemptions are not required, right? So, in case you are taking any of these exceptions, you have to do appropriate disclosure obviously in the notes and accounts, and whatever the accounting policies you are following for MSME, this also has to be specifically mentioned by way of disclosure. So the general assumption is that you are following the company's accounting standard rules, but any specific exemptions you are taking like idle plant and equipment, dismanagement policy and all those things, you would have to give a separate disclosure or small note saying that we are not following these particular, so we are following these exemptions given, or we have availed of these exemptions given for these particular exemptions or these particular accounting standards. Okay, I think it's time for a break. Ishwar sir? 15 minutes, 15 minutes break. Thank you. We saw about the standards a little bit, exemptions, all that we discussed, and how the MSMEs, the categorization has been changed from those 4 levels to maybe 2 levels now. And I think once again, one of the things we have to appreciate with ICAI is that you name the area, they have a publication for that. Any area you take. You take any area. You take auditing standards, you got auditing standards. You got Ind AS, you got Ind AS. Accounting standards, you got accounting standards. Guidance note, everything is there. So I think one of the things which is really appreciable, though sometimes it may sound to be like overload of information also sometimes, is that any particular area you take, you have got some sort of a material given by the ICA for followings for that particular requirement. I'll give you another offbeat example. So much of discussion is happening about US aid today. All whatever is happening, all of you must be knowing about it now. Institute has got a guidance note on accounting for political parties, in which they have said that all these donations given have to disclose separately. It's been there for a long time. Similarly, for non-corporate enterprises, and this is something which I am sure all of you all will take to very immediately, they have given us a very nice guidance note on the financial statements for non-corporate enterprises. I want to make a distinction here. Accounting standards, companies accounting standard rules 2021 circular. With exemptions given in those individual accounting standards, we saw this before the tea break. What format do you have to follow for the financial statements? Please remember, we are not talking about Companies Act Schedule 3 here. That format is there, but we are not talking about that here. So what the ICA thought, just like how that CFO of the company thought was that, if I give a format, what will happen? It will get filled up. So they have given us this excellent publication called as Guidance Note on Financial Statements for Non-Corporate Entities. Again, I want to emphasize that even though it's a guidance note, please don't say it is only a guidance note and I will not follow it. You should also think about what will happen if it is not there. If this guidance note is not there, what is going to happen? You have to think of that repercussion also. And what you all can also do is that we understand that most of these MSME enterprises, one area which has always been an area for discussion is the audit fees. It's always an area of discussion, dispute, debate, whatever you may call it. Correct? I hope none of the MSM enterprises will listen to this at some point of time in the future. But I think what you should say is, please don't say it's a guidance note, say it is mandate. Because that will be one good way in which you all can probably claim a higher audit fees. And tell them, just give them this publication, give them a printout, or give them the actual publication, it's free of cost. Send it to them and tell them this is what we have to follow from the current financial year, 31st March 25. So number of pages is increased, therefore audit fees also has to necessarily increase. I think this is going to become an excellent excellent tool for all of you all to ask at least for one-time increase in audit fees. And let me also tell you all the good news. The institute has also given us Excel format of these financial statements. So you don't even have to do the typing. Excel format is also there. You just have to download the Excel format. Luckily the figures have not been filled up. No, that is not been pre-filled up. You should be thankful that there is no pre-filled figures there. Otherwise you will say that itself is our set of financial statements. So we will make as per the necessary adjustments what is required. So they generally said that is applicable to all of these enterprises which are non-corporate entities. Please remember one important exemption given here is list one. What you will not find here are LLPs. LLPs are not considered to be non-corporate enterprises. LLPs you may still fall back upon the Companies Act itself. Still you may fall back upon the Companies Act itself because you are going to specifically say this LLP or whatever it may be. The basic format, face of balance sheet, face of P&L account, you can follow the Schedule 3 format. This format may not suit the LLPs, and they have also given some small exemption for trusts under the Maharashtra Corporation Trust Act and all those things. Education institutions, political parties, non-profit organizations. For them, institutes said they've got separate guidance material. So you may have to follow that individual guidance note, may not necessarily follow this, but I think what we are trying to basically discuss here is non-corporate entities who are in a business format or who are doing business. They are not non-profit, they are not, let us say for example, education institution, they are not a political party. Such enterprises, this format is going to be useful. It's applicable beginning on or after 1st April 2024. The technical guide has been superseded, so this format, this guidance note, immediately available on the ICAI website, resources, guidance note. If you go to, you will be able to get this. This stands on top there. Please download it and you can start implementing this immediately. Because what is a very important statement which comes out from this is that, and I think this is something which has been rather undersold over the last so many years, is the fact that at least in terms of presentation of financial statements, there should be uniform. At least in terms of presentation, you should have uniform. You may have different accounting policies, you may have different accounting requirements, you may have different business models, whatever it is. The general idea seems to be that in terms of presentation of financial statements, this format should be uniform so that, again, this word called as the user of financial statements has got one consistent format across all the set of financial statements. So this format which has been given by this guidance note is very, very useful for that. You can see here that it is almost the same as what we are seeing from the Schedule 3 of the Companies Act. Only thing is that the terms being used are slightly different. We don't have equity share capital, obviously for the reason that they call it as owners, funds and liabilities. Owners capital account, partners capital account, because partnership firms can use something called as partners capital account. Once you remove the capital portion, all the rest becomes very familiar for us. All the rest are very familiar for us. You have your provisions, your long-term borrowings, deferred tax liability, short-term borrowings. All of these things are known to us, all of these things are familiar for us. They have also given a mandatory requirement that if the amount is material, there has to be a cross-referencing with a note. You should have a cross-referencing with a note number. Accounting policy also will obviously follow that. The format also suggests that comparatives also have to be given for the previous year, or for the immediately preceding previous year you have to do comparatives also. Similarly, if you look at the non-current assets, you've got something called as property, plant and equipment, intangible assets, all of these things which are quite well known to all of us, trade receivables, all of these things which are there in the Companies Act. And a very interesting thing has come below the total. They have said a brief about the entity. So you would see that most of the companies, what they do before they start their accounting policies, they say that this company is in the business of this particular thing, it was established in the year, and this what they are doing. So they are asking us to also give us a little bit of a brief of the company, what nature of business, what is the company establishment and all those things. You can give a very short note about it. And they are also talking about summary of the significant accounting policy. So this format has literally taken up from the Companies Act Schedule 3 itself. Wordings may be slightly different. In fact, what they have also done in the Excel format is the entire set of schedules also has been given. The entire set of schedules also has been given, so that your work is only to link this with the trial balance. Your job is only to link this with the trial balance. Once you link with the trial balance, your entire set of financial statements in the format given by the guidance note is becoming much more easier. It becomes much more easier. Of course, the fact remains that, as we have also discussed, accounting policies can vary. But again, here, I think what I should need to call out and tell all of you very clearly is that this accounting policies, again, I think this is a good time for all of us to go and tell the company that you have to be a little bit more specific about your accounting policies. For example, revenue recognition. What is the accounting policy which is generally followed? You will make a blanket statement saying that revenues recognized and significant risk and reward have been transferred. This is exactly as per the accounting standard. But I think what we need to know is, what is that event which is driving that significant risk and reward being transferred? Is it delivery? Is it bill of lading? What is that event? They just want a small description saying that please go a little bit further and tell these people that what is that significant risk and reward. In fact, one accounting policy, I saw a very, very strange accounting policy from I think he was an exporter of this, some agriculture, not agriculture, some shells, equipment or whatever it may be. Revenues recognized on shipment or delivery. This is accounting policy. Revenue is recognized on shipment or delivery. Export. Shipment happens from Visakhapatnam, delivery happens in US. Accounting policy says shipment or delivery, he doesn't say whichever is earlier or later also. Option is given for you to recognize whenever you want, you can recognize your accounting policy. Again, here I think what I want all of you to really think about is that this is just a one-time effort. 31st March 25. Sit down with the client. Anyhow, you're going to get more audit fees. Tell them that I will redraft your accounting policies to give a little bit more detail about exactly what. See, the idea is not to give too much of information also. But I think if you want to make it relevant for users of financial statements, whoever they may be, I think the idea is that give a little bit more detail, because these disclosures are becoming extremely important. Since we spoke about GST, I've given this very simple example. It actually turned out to be a very humorous example. This is when GST was introduced. Software company, 100% export EOU, claiming refund on ITC paid. We assume that it's a very simple transaction. Right there from service tax base itself. Same formula followed here. GST department sent a notice saying that please send your annual report. Annual report was sent. 55 crores of turnover. Schedule said export turnover. The schedule of the financial statement said export turnover. Department sent notice 55 crores into 18% pay tax. Early days of GST I'm talking about. So the CFO went to the GST department and told them, sir, we have not been paying service tax. He said, no, service tax is different, GST is different. Officer said, no, both are different. Now you tell me, export. I said, export turnover, 100% export. So he gave various, documents to prove that ultimately, but please remember, notice was there, 55 crores into 18% into interest penalty equivalent amount. Same amount. Interest penalty they never changed. So ultimately he was convinced that, yes, this is export turnover. He said, okay, fine, I'll drop this. But you are claiming a refund for input tax credit. Yes, you are claiming, sir. That also we are claiming from service tax services. All these services, why they are required for export? Not required for export. We given a breakup. In the P&L account, you given a breakup of what and all expenses are there. That also there. In front of all the schedules and everything also. Schedules helped a lot. So one question which the officer asked was, how is security guard service important for export turnover? You are claiming input tax credit refund on security guard service. I don't see a connection between him and export turnover. That I will disavow. How is chartered accountant certificate required for important for export? You get professional fees, CA certification for whatever the export RBI form is there. That also. So like this, he kept on disallowing about out of, they have this golden rule, 70% allow, 30% disallow. That's what happened. But the CFO was always saying that, how can I disallow arbitrarily? So they discussed and said, okay, fine, we'll do one thing. All this time in service tax, we used to go to their office for the refund of the documents. What we will do now is, we will make him come to our office. It actually happened. I am not, there's no, this thing in this. So CFO said, we will make him come to our office. So promptly the officer one day called and said that we want to come to your office for this refund. Actually they said, we come to our office. They said, no, we can't come to your office. They said, we come to our office. Instructions were given to the security guard. I think all of you know what happened there. How do you prove that security guard is important for export business? Instruction given was, he will come, don't allow him inside for 1 hour. Do whatever you want. Don't allow him inside for 1 hour. Please imagine security guards throughout the day don't have any work. If you give them this job, what will they do? He made it 2 hours, all the more important. He said, nothing, I'm not going to allow this person inside at all. Let us see. Our boss has given the instruction. It actually happened. It actually happened. He was waiting outside. Then he went after 2 hours and said that, what is this? You made the security guard make me wait on this process, sir. All for export only, sir. I'll allow that, no problem. So he got, out of that 70%, 80% he got. The officer was obviously very hungry. Then he said, canteen. He said, canteen today closed, sir. And so it was open also. But anyway, the point I'm trying to drive is schedules. When you looked at the schedules and found export turnover, he was able to allow that exemption from export turnover. So even though we think schedules are only a part of the financial statements for the purpose of giving this information, as I said, you never know when it is going to actually help you out. So this format you can follow. Significant accounting policy, I just told you, be a little bit important, be a little bit more wary, because I think the accounting policy should not only be a repetition from the accounting standard, should also give a little bit of information about the specific circumstances for that particular entity. P&L account, not much which we are unaware of. Revenue from operations, other income, we know about all of these things. Exceptional and extraordinary items, both are there. Accounting standards have always followed this. Exceptional means, which is one time. The difference is actually very, very thin. Index is always used only the word called as exceptional items, which means it is a item of expenditure which is or income which is not very common but very high in value, you have to show it. A significant impairment, for example, can be a exceptional item here, but they also use the word called as extraordinary item. Here, extraordinary would mean that normal course of business, some expenditure income is there, but the amount is so high that you want to call it out separately and show it there separately. You also have to give a separate note about that here. Before the partner's remuneration, there is a very interesting insertion in the P&L account. Partner's remuneration has been shown separately in the P&L account. The partner's remuneration is a separate line item in the P&L account. Again, I would want to repeat, tell all of you that this is only an illustrative format. It is not a mandatory format. If you want to show the partner's remuneration under, where will you show it? The employee benefits, show it. Nothing prevents you. But guidance note seems to be thinking that I have to put this separately as a line item because for these non-profit entities or non-corporate entities, this can be a very important item. Therefore, they are showing it similarly. They have something called as excess short provision of tax in the earlier years. Again, please remember, this is something which all of us are very familiar with. We know this very clearly. This happens in every entity. We have an advance tax payment. We have an income tax return file. Normally the two will not match, there will be some sort of a difference. So we keep income tax assessment year wise. Assessment 24, 25, 23, 24, we keep it separately. Under the impression that when the assessment finally happens, if there is a demand or there is a refund, I will set it off and account for it accordingly. That is the idea behind showing this or keeping this assessment year wise details in your trial balance. Now here they got an entry saying that excess provision reversal for the earlier years. So basically what they are trying to say is that if you had a provision for income tax in the previous year, settled in subsequent years because assessment has happened subsequently, that difference you put here and show it separately. It is definitely not current tax because it pertains to the previous years. Whatever additional income tax you have paid because of a demand or whatever you have got back by way of refund, show it separately here. It will not impact your current year's tax. The general idea behind this presentation of financial statements as far as tax is concerned is that your net profit for the year into your applicable income tax rate should invariably be your provision for tax for current tax. At a very broad level, I mean, there will always be some differences because of advance tax paid and interest and all those things. But at a very broad level, if you are paying at 15% tax or 25% tax, net profit for the year into 25%, at a very broad level should be your provision for the current year's tax. So whatever taxes you are paying for the previous years and all, you can show it under your, what you can call as earlier years here. Profit and loss from discontinued operations has also come in from the, the Companies Act Schedule 3 itself. Please remember here, there is an important difference. There they use the word called as discontinued operations, which means that the operation had to be discontinued. Here they are saying discontinuing operations. You plan to discontinue the operation. There is a proper plan to discontinue the operation. You don't hold any of those assets for sale. Even that would come under your discontinuing operations. No revenue may possibly be there or it can be very nominal revenue. Those profit or losses will have to be shown separately. So the word is not discontinued. For example, this insolvency and bankruptcy code, which is, many of these companies go to the insolvency and bankruptcy court for the purpose of resolution there. The idea is that if they go to the insolvency and bankruptcy or they go to the IBBA or the IBC under the IBC, invariably there is going to be some sort of resolution. You can say operations are not going to be continued, discontinuing operations. That could also come under discontinued operations. What is very important for us to understand is that it has to be admitted in the IBC or the NCLT. One of those two things. Just as mere plan to go to the IBC may not necessarily require, so some event should be there. Even though they use the word called as discontinuing operations, there should be some event which says that why is it showing as a discontinued operation. Another thing which is very familiar to all of us, the last part if you can please look at, which talks about the accompanying notes are an integral part of the financial statements. This is not only a sentence, it also has to be It also has to be correct. What does that mean? They use the word called as, if your balance sheet is an aggregation of those financial items, the notes and accounts are a disaggregation. If I have got property, plant and equipment of 50 crores in my balance sheet, it's an aggregation of the amounts. The notes and accounts are a disaggregation. Its breakup will come from the disaggregation, from the schedules, so we can call it. This has got two parts. One is the quantitative part, schedule. Schedules are already given in the format. You will definitely download it, you will use it. I am not talking about the schedules as far as the quantitative part is concerned. I am looking at the schedules from the point of view of the narrative part, description part. What are you going to disclose there? Now the general tendency has always been that in case there is anything specifically required by the accounting standard, I will disclose it. If AS says you have to show idle equipment, I will show idle equipment. If AS says I have to show discontinued operations, I will show discontinued operations. Generally, they always felt that disaggregation of items in the financial statements would be taken to mean that I have a schedule, I give whatever disclosures are required as per the applicable accounting standard. Now, there are two things which are very, very important here. The first is that the AS itself does not give you all the explanations required. AS does not give you all the explanations required. For example, I showed you that provisions of movement is not required. In the provision, the AS 29, the movement opening balance provision, that is not required for MSMEs. The table is not required. But in case the entity has made a significant provision during the year, suppose entity has made a significant provision during the year, because of whatever it may be, it could be a tax demand, it could be anything else, they made a significant provision. You are going to say provision for this particular thing in your schedule. That's going to be, that's definitely going to be there. But what is also important is, along with the schedule, you also have to give a small note saying that during the year, the company got this particular notice from the department, therefore a provision of this much has been made. The idea behind this disaggregation is not only a quantitative disaggregation showing what is there in the balance sheet or breaking down what is there in the balance sheet, it also has to be a narrative portion wherein you are saying that any significant change during the year will have to be shown or disclosed separately. Now, again, what is significant, what is material, whether we have to show it generally also, all of these things are completely judgmental. They are completely judgmental and they are obviously entity specific. But I am assuming that if the amount is very, very material, if the amount is significant, you will have to show a small note saying that this is what has happened. I will give you an example only for the purpose of provisions, because you are talking about provisions. I still remember this, a long time back this happened, but still. As all of you all know, in the budget, every year budget we all wait for. Why do we wait for the budget?
Exemption.
Sir?
Exemptions.
Exemption, okay. Exemption, always, it's become a national event now. So everybody's become an expert one day before the budget, Monday after that, then everything becomes, back to normal. I remember this in 2015, 2016, always you see customs duties on budget, especially excise duties, I think excise duties on cigarettes was always based on the length of the cigarette. It was never based on price. Look at any budget, the idea is that the longer the cigarette, they call it syntax. Why they call it syntax? For a reason, no? To smoke a longer cigarette, you have to pay more. That's what it is. Anyway, 2015 budget did the same thing. They said additional excise duty of some whatever percentage, which will have to be paid. And we have got only about 4 or 5 companies in India who actually manufacture cigarettes. Biggest, of course, has been ITC. See, somebody showed me present stock market slide, ITC has not gone down at all. ITC is going up only. Consumption is increasing. If you look at the cigarette packet, apparently ITC has also got MRP put on the cigarette packet. Excise duty they are paying based on dispatcher factory date depending upon the length of cigarette. They also have something called as MRP which is put on the packet apparently. Head office of ITC in Calcutta. ITC Calcutta. 2015, this budget came in the month of March or April. I think that time it was April. I think April, May it was. July they got a notice from Excise Department saying that you are paying excise duty based on length of cigarette. You are also putting MRP. The difference also you have to pay excise duty. They had some calculation. Demand was about 2,000 crores. 2,000 crores demand. This is from Excise Department. 2,000 crores followed by 2,000 crores of interest and 2,000 crores of penalty. That's all of them. That follows the natural course. ITC have got the best lawyers in the country with them. They said, okay, fine, please give me the demand notice, no problem. We'll put an appeal against this. The appeal said that you are going against the national budget itself. You forget about Excise Act. I am paying based on the national budget provisions. How can you ask me to pay additional tax? Anyway, they put an appeal. This is 31st. This happened in August 2015. 31st March 2016, they have to close their financials. What will they show in their books of account? Very good, sir. Contingent liability. But then one event happened. In the month of March, as all of us know, for chartered accountants, month of March is a very, and companies, month of March is a very dangerous month. Excise Department came to ITC and told them that I know you filed an appeal. I know you will win. But it is March. Little bit our revenues are down. We've got targets to meet. Can you pay some deposit? Can you pay some excise duty? I said, no, I am going on appeal, I can't pay. I said, no. Please help us because department, no. 2,000 crores. How much is the deposit they asked for?
10%.
No, not 2,000 crores. Okay, 10%. 10% I take. Some amount. 200 crores they paid. I think they paid 250. Very clearly saying that payment under protest. Payment under protest. That provision was there in excise law that time itself. You want to pay something or pay under protest. So ITC gave a payment saying payment under protest. That also they disclosed. Saying that we are paying under protest. So 2,000 crores out of contingent liability, advance paid of 250 crores, showing very clearly is a payment under protest. Excise Department, lot of delay in appeals, nothing happened in that year. One hearing was pushed in 2016-17, it got adjourned by the department people. 2017, copy paste, March. What happened? Sir? Okay, whatever amount. It doesn't matter, amount is immaterial now. Now amount becomes immaterial now. So 2,000 crores, ITC paid, let us say 600 crores. Same, 2 years, same description. So Mr. Banerjee was the CFO of ITC. He thought that if this goes on for 3 years, what is going to happen? I'll have 2,000 crores worth of contingent liability, I'll have 2,000 crores worth of advance. So it's not going to be a very viable scheme. So he used a little bit of pressure and told the commissioner, please hear this appeal fast and get it disposed of. Because we can't keep doing this every March. In 3-4 years I'll have this problem. Anyway, 17-18, this was heard, dismissed by the tribunal saying that this is not a viable demand, this is only based on length of cigarette. So they told the department that, all of your experts in GST, what was the order given? Please refund with interest. Order, demand came with interest. Order came, please refund with interest. 600 crores, please refund with interest. Can you tell me which excise department in the country has got 600 crores worth of cash? No. So this order came in the month of December. In the month of March, again excise department came to ITC. This time what they said? Don't pay me. Oh, it's over now. We know that you have won it. ITC's only fear was that will they go to the High Court? If they go to the High Court, one more contingent liability again there. Again one more cycle will start there. But thankfully the officer who came did not say that we are going to go to the High Court, pay us 10%. He said that order says we have to refund you with interest thereto. Total comes to about 718 crores. We don't have that much of money. So I said, what are you going to do? He said, future dispatches, adjust this. Don't pay excess duty by cash. Any future deposits you have got, you please adjust the 718 crores. From 2018 to 2020, 2 years, ITC paid through this, what we call as escrow account. But what was most interesting was 31st March 2018 financials. Contingent liability removed from the balance sheet because no longer the department not going and everything understood, so contingent liability removed. Now the refund has come. Well, not refund has not come, but at least the order for refund has come. What do they show? Of course, ITC was Ind AS at the time. Ind AS had this concept of contingent asset, not accounting, only disclosure. Disclosure. Ind AS has got it. So they said that, in the sense, though this was an order which was given, the department is saying this. So they said that we are right now showing this as contingent asset. As and when future dispatches are going to be made, we keep on relinquishing this from asset and show it as a part of our commitment to the payment. Why did I tell you all of these things? The only thing I told you is because this accompanying note for the financial statements, especially for contingent liabilities, it is not only tax demands, it also includes any amount possible obligation from a past demand. It's not only a description of what that amount is, but also you may have to give a small description of what it is there. India has never had a format for the cash flow statement. This accounting guidance note also does not give you any format. You can follow any format for the cash flow statement. I think all of us know by now that cash flow statements, we are experts in how to make it tally. So whatever format you are following right now, continue it. If you are linking it with the financials, you have to link it with the new set of financials. That much you take care of. That much you please take care of. Don't link it to the old set of financials. Trade payables, especially MSME, there is a separate disclosure which has been given there. Please remember, you are giving accounting standards for MSMEs. Trade payables, whatever is there as per the MSME Act, the guidance note has said that this also has to be shown separately by way of a disclosure. Exactly the same provisions have been continued there. There has been no change for the MSME disclosures. Now, we all know how we are disclosing this. Continue the same format. Please remember that many of you have probably been aware of this. There is something called as TREDS platform now, wherein a lot of these transactions of payments also take place on this TREDS platform, wherein buyer and seller sort of, they can do factoring, a lot of things are happening on the TREDS platform. If your MSME vendor is on the TREDS platform and asks you also to join the TREDS platform, because there could be a discount which is happening, whatever it may be, please remember that if the TREDS platform is, both of you are there on the TREDS platform, disclosure becomes all the more important. Right now, what are we saying is that if he tells me he's an MSME, I'm disclosing it. I think that is accurate enough. If he does not, I don't know that he's an MSME. So whoever had told us that they are MSMEs will definitely get captured here. Important distinction to make is that MSME as per MSME Act and MSME as per accounting standards, there is a difference. So this schedule of trade payables is only for MSMEs as per the MSME Act. Whatever you are following the normal course of MSMEs, nothing to do with the accounting standards there. So therefore you have to be a bit careful about this particular disclosure also, right? Now not only has the institute given this guidance note, they have also given us what is called as general instructions. I have not reproduced the entire thing there, but as I said, they have just followed the Companies Act. So this is As I said, you've got about 3 months time now to actually finalize all these MSME balance sheets. 3 months I think is a good enough time for all of you, apart from that month of April or the 15 days of April when all of you will be busy with bank audits. I think 3 months is a good enough time to implement these new provisions. Read the general instructions. Current, non-current, all requirements as per Companies Act exactly has been met here. They've also given out the rounding up. They've also given out the rounding up, hundreds, thousands, lakhs or millions, lakhs, millions of crores or decimals thereof. Many people have asked this question, and I think again this is something which will probably come to all of you also. Why can't I present in absolute numbers? For tax audit it is very important. Absolute numbers are very important for filling up tax audit form. If I am going to present here in lakhs, millions, crores or whatever it may be, again I am having to do a reinvention for my tax audit form. Why is this not, why are they not allowing us to give actual figures? Because we need to accept the fact that for some MSMEs, the figures will look better in actual figures only. If you do it in lakhs also, they may not be very attractive, shall I say, whatever it may be, doesn't matter what it is, right? So I think this is one area wherein you need not necessarily follow the guidance note. It's only a guidance note. If you are of the opinion that it eases your process of finalizing the financial statements of MSMEs, especially for tax filing or wherever you require it for absolute numbers, don't have to do it. You can give absolute figures because it is only a guidance note for this particular purpose only I am saying. So you don't have to worry about it. Okay, then of course, as I told you all, this is again not produced there, but the Excel format is also there as a part of the guidance note. You are free to download the Excel format, use it whatever you want. So basically what will happen here is, if you just allow me to go back for a minute, if you are following this particular format and you have downloaded the Excel format, invariably your 31st March 24 trial balance, 31st March 24 trial balance, if you are able to export to this format, you are able to export to this format 31st March 24 trial balance or 1/4/24 for all practical purposes, transaction being accounted anyhow accounted in your accounting package, it becomes easier for you to transition to 31st March 25 also as per this particular format. Again here, whether you use Tally, whether you use QuickBooks or whether you use Zoho Books or whatever it may be, if your accounting package permits you to give these classifications, please do it. Makes it much easier. If your accounting package allows you to do these classifications only for broad headers, I am saying. We all know what is going to happen. Ultimately, Excel only is going to be our final set of financials. It is going to be an Excel only. But I am saying the first cut, for the first cut, if it is going to help you to have these headers in your financial statements, makes a lot of sense. Then you can probably use this and say that, okay, this is my first, then you export to Excel and use this particular thing here. I think ICA has done this also quite, with the intention of only assisting all of us to transition to this very, very easy. So one broad question before I move on is always going to be that, all this I have said, guidance note, all this is very, very good. MSME client authors a chartered accountant. He knows it's a guidance note. He's saying go on to all these things, follow the whole format. Is that okay? Still perfectly okay, I'm not saying no, but as I said, this is an excellent opportunity for us to actually transition to this particular, what you can call as, new set of accounting standards. Not really new, but if you look at it from the point of view of exemption, those exemptions and all those things, it will really help us a lot. So I think this is a thing we can also start. Sir?
Is it mandatory for all of them?
Only guidance, not mandatory.
So if they want to follow the old system,
You won't get your fees, sir.
let you get the old fees.
Get your own fees first. In addition to this, I thought I should also take this opportunity to tell you all a few things about what else the institute has been doing in terms of this non-compliance. Sorry, I won't say non-compliance, but what they call very nicely a study on compliance, which means there's been a non-compliance. The moment you have a study on compliance, that means there's a non-compliance, obviously, right? And very interesting that the institute has brought this out in 3 volumes for AS only. For AS there are 3 volumes, for Ind AS there are 3 volumes. this seems to give the impression that generally we are following, but there are also instances when we are not following. And in the latest version, which was came out sometime ago, 3 or 4 years back, they have also given us an area of non-compliance. And please look at the tallest person in this graph. Look down. It is Companies Act. Dangerous situation. Anyway, we'll come to that. That number, I don't even know what the number is. There seems to be some huge number. Okay. Caro is 7.6%. Others are 6.9%, maybe IFC and all those things. But in terms of accounting standards itself, non-compliance accounting standards, the winner is AS3. Cash flow anyhow exempt. So they are definitely non-compliance only. I don't know why it's 8 points, it should actually be 100%. Because anyhow it's exempt for all of us, right? But AS15 is a very interesting thing, 7.3%. But I was actually very, very surprised with the other numbers like AS9 and all those things, only 2%, which means that we are generally complying with the main standards which are required. But this graph shows us that, or this diagram shows us that, most of the non-compliances have come from the Companies Act itself. As far as AS is concerned, to a large extent, we are complying with accounting, which I think is a very significant statement to make, considering the fact that we've seen so many situations wherein there's been a situation of non-compliance also. But AS1 at 5.1% remains a little bit of a concern, because if you look at accounting policy, I told you, just giving a description of the accounting policy is not sufficient. You have to give a little bit more than that. See, these are numbers which have been taken from actual studies done by the FRRB. The FRRB has done this for AS companies over 3-4 years and got this particular statistics. Now, one thing which you are probably going to ask is, and I'm sure this question is definitely going to come, what is non-compliance with the Companies Act as far as an accounting standard point of view is concerned? 129(5) is there, no doubt about it, it says accounting standards there. But I think this compliance or this non-compliance, so to speak, is not about accounting standards per se, but with the provisions of Companies Act itself. Various provisions of the Companies Act, I think that is what has been the significant finding. There could be individual provisions which could probably be very, very important. This does not talk about auditing standards, does not talk about audit report. Further, there are separate reports. I am only focusing myself on only what is as far as the financial statements are concerned and what is concerned to be. See, for example, Schedule 3 non-compliance can be there. Schedule 3 non-compliance can be there because you may not have followed the exact requirements of Schedule 3, right? One accounting policy which they have said is very nicely worded accounting policy. In appropriate circumstances, revenue is recognized when no significant uncertainty exists as to measurability or correctability. This is actual accounting policy which has been given. In appropriate circumstances means what? Okay, I am not going to further elaborate on that. I can show based on correctability or when no significant uncertainty exists as to measurability or correctability. I think what we need to realize here is that revenue in general, I am sure that all of you will know about this. The significant risk and reward, I told you that event has to be mentioned. What is that event in which significant risk and reward has been transferred? Also, please remember that collection should only be probable, not possible. The word used is probable, not possible. If I am expecting to get the money from that person, I recognize revenue. I don't say he will pay me, he may pay me, I don't say that at all. So, accounting standards right from AS9 itself have always said that when significant risks and rewards have been transferred, you recognize the revenue, but collection should only be probable. You don't have to worry about the word called as possible. I'll give you all this example just to, though this is not an Indian example, it's a very interesting example to give for revenue recognition. Hewlett Packard, all of you know. Hewlett Packard laptops, many of you must be using their laptops. Salesperson in US. You know how the salespeople in the US are rewarded. They've got a basic salary and they got an incentive based on number of laptops which they sell. So this particular salesperson from North America, he had a base salary and he had a incentive package. The more laptops he sold, the more incentive he got. So it was like this: if he sold 50,000 laptops, he got $500,000. Just to put some numbers in front of you. You are the salesperson. What will be your target? What will be your objective?
Sell more.
Very good. Sell more. So this person went to all the top companies in America and told them that this is the latest laptop from HP. You don't have to buy it. Keep it with you. Use it for 3 months. Use it for 4 months. You see how it is. Once you are satisfied, you tell me whether you have to buy it or not. It actually happened. He sold what? 50,000. He sold 70,000 laptops. Right? If somebody comes and gives you a laptop and says keep it and use it for 3 months and you don't take it. Obviously, he is not worried about US GAAP, he is not worried about IFR, he is not worried about significant risk and reward. He wanted to sell the laptop. US GAAP had a brilliant provision said that the moment you give delivery, you lose control. The moment you lose control, you recognize revenue. The moment you give delivery, you lose control. The moment you lose control, recognize revenue. So Hewlett Packard recognized revenue on all the laptops which were delivered by this man to various companies without actually being sold, because accounting had always said that collection is only probable, not possible. He gave these 50,000 or 70,000 laptops, went to HR department and told them, went to accounts department and told them that I have sold 70,000 laptops, can you please give me my incentive? HR department said no problem at all, get an okay from the HR department, I'll give it to you. He went to HR department. All of you know what HR department does. So they gave the laptop, they gave the approval. This man came to accounts department 2.5 months after he gave these laptops. He got his commission for the incentive of $500,000. Next day he, very good, he resigned. He resigned from the company and went and sat, was holidaying somewhere in some island he was on. He was enjoying himself in some island. One poor accountant like you and me sitting in HP finally realized that I have to get the money from these laptops. So he called up the first company and told them that my person has given the laptop to you, when are you going to pay the money? The company said that time also didn't want the laptop, even though I don't want the laptop. So please take it back. I don't want the laptop. So out of those 70,000 laptops sold by this one person, almost about 40,000 laptops were returned. US GAAP always said that delivery means losing control, recognize revenue. But they also said that collection is only possible, probable, not possible. But they also had a provision that said that in case you are making an estimate for non-collectability, you should provide for that also. They said we did not know about this. So out of these, whatever these 50,000 laptops were returned, they were shown as older concept of sales returns. They were shown as sales returns. Everybody questioned HP and said that how can you have this accounting policy when you deliver you recognize the revenue without the money coming in at all? HP said, listen, this is what US GAAP is saying. I am not saying this. What was the document in which you recognize revenue? For every laptop he sold, he had a delivery note. For every laptop sold, he had a delivery note. Delivery note was given to Oracle, all those big companies. He had a delivery note given to so the delivery note itself became the document for recognizing revenue because US GAAP said this. So we have to be careful about our accounting policy for revenue recognition. What did it say? I already told you about this, right? So look at this one provision here. It says that depreciation rates on some of the fixed assets have been revised to keep them as per the requirements related to the Companies Act 2013. I think this is for this particular year. I think this is what they are talking about. Only for this particular year, they have said that you have to be very clear about this. Okay, I'll only tell you all the important things because you understand the important of this. Again, just to talk about revenue. Revenues are recognized on actual basis as they are earned. No idea what that meant. Costs are recognized on actual basis as when they are incurred. Matching concept. He said revenue I am doing like this, cost also I am doing like this. So he is ensured that paid account is balanced or tallied, so to speak. VAT and GST cannot be included in revenue obviously. So, okay, now as far as fixed assets are concerned, I think one thing which I thought I should probably tell you all is this word called as control comes into play, economic benefits comes into play. Whenever there is control or the entity has got control over those assets, that is when invariably they can recognize it as a fixed asset in that. So the control has to be demonstrated. It could be by way of purchase, it could be by way of additions to the asset, whatever they can have this. Many of you would have probably seen this. Land has been given on 95 years lease. 95 years lease land has been given. Non-cancelable 95 years lease. There is a one-time payment for that initially, and every year there are some very nominal lease payments. Very nominal lease payments. For all practical purposes, it's a non-cancelable lease for 95 years. I paid a significant amount upfront. I don't pay it as normal lease rental. I paid a significant amount upfront and paying just something sort of maintenance charges to maintain the lease for 95 years. Standard says if you got control, it will be recognized as an asset in your books of account. So many cases you will find that this leasehold land actually is an asset because you got control, it's a non-cancelable lease, you paid a significant amount. How do you have control? No changes can be made to the leasehold land without your permission. That clause should be there, that any changes, additions, you only will be able to do it, and permission is required if anybody wants to change that. So please look at this word called as control, which is very, very important. Okay, just a few important things I will show you. I don't want to give too much of this thing here. Okay, investment in shares of some cooperative bank has been considered under government securities. They said it is AS 15. You saw that 5.1%. Many comments on non-disclosure under AS 15. AS 15 is only a disclosure-based standard, employee benefits. It is not only about the actual valuation, it actually gives a lot of those disclosures himself. There's only one part of it. The employee benefits per se, consist of what you call a short-term employee benefits and long-term employee benefits. That also becomes important. What they are saying is, whatever is required by the standard, you please follow it then. Okay, they also found a few differences between the financials and what is called as management discussion analysis here. Just one-off transaction probably explosive chemicals division shown together in your financials, but the management showed it separately, so they said you have to call this up probably separately here. In many cases in AS 18, the study has found that nature of relationship has not been disclosed. Again, I will repeat what I said earlier. For all of us, holding, subsidiary, joint venture, associate, definitely related party. KMP, definitely related party. Apart from this, there can be other people also who have got significant influence. They will have to be also shown as related parties. So the nature of relationship has to be also disclosed. I'll give you another example. Sole selling agent who determines the pricing. You've got a sole selling agent. He determines the pricing for your products also. He may have significant influence. You may have to show him separately as a related party because he's got the influence over the pricing. So like this, I think, as I said earlier also, what is important is discovering who is a related party and also this thing. A common question we get across in the leasing standard is when you are doing this present value for that future lease requirements, the most popular discounting rate in India is how much? most popular discounting. This is in fact observed by the IQVIA itself. They say the most popular discounting rate in India is 10%. Why? Very simple on Excel, that's why. There is no other reason. It's very simple on Excel. Actually what they say is risk-free rate. Or you can call it as working capital rate or ICC, internal rate of return, whatever you may say. But whichever way you look at it, it will come to 10% more. The Government of India Treasury bond should be your best rate for discounting anything on the asset side of the balance sheet. The table rate today is 6.53%. Approximately 6.53%. That's your 8-year Treasury bill rate. 6.53% Government of India. You are not the Government of India. So you add a risk premium. How much you will add?
3%.
Correct. 3% only. You don't add more than 3%. 3% makes it 9.53%. 0.953% Excel now is going to become. So what do you say? My risk premium is 3.67%. You will not make it 3%, you will make it 3.67%. One question which comes up is, should we disclose the discounting rate? There is actually a requirement wherein it's better you disclose the discounting rate because people will be able to make out if there is any change in the discounting rate which has to happen. Okay, one more interesting thing which was observed by the FRLB was that the value of assets held for disposal in the standalone financial statements was more than the consolidated financial statements. They got shocked. They said, how is this possible? Standalone they are having 10 crores, consolidated having 5 crores. I mean, there's no reason which was given for this unless transactions have happened between the enterprises. Knocked off in consolidation, that's the only explanation I can possibly think of this for this point of view, right? Okay, then all these are just small things. One interesting thing which came up was intangible assets. Can the value of intangible or intellectual property rights be the same as the figure in the previous year? Which basically what they said was no amortization has been made for intangible assets. The standard says useful life amortization is mandatory, so it cannot be the same as the previous year. So again they said this could possibly be a non-compliance with the standard because of the fact that amortization has not been done. Even if you don't have a useful life, you should put together useful life and actually do your amortization. That's what they're trying to say. This also I have told you all. Okay. So liability and scheme remains unclaimed. Company wrote back. Okay, this is a very interesting thing. I'll probably end with a couple of these things. There was a scheme of arrangement with a company with another person. Company had to pay something, pay some amount. That person did not claim. What will you all do? We have this classic thing of period of limitation of 3 years. We wait for 3 years and say law of limitation kicks in. If it is not paid, if it does not claim within 3 years, I will write back. Which is what I think, logically speaking, everybody should do the same. No doubt about it. But here what they did, the company wrote this back and said that, however, this will be paid as and when it is claimed by the parties. First of all, writing it back. On top of it, you are saying that if he claims, I will pay it. So what I saying is that the moment you write it off, you should not be paying it. Or forget not be paying it. You should not be saying that you are going to pay it. When the claim comes, you see, then you use law of limitation, all those things. So you don't say that, because they have again taken a literal meaning for this word called as obligation. When the obligation is cancelled, you reverse the entry. Once you reverse the entry, the obligation does not remain any longer. You don't have to use that particular obligation. So I think that also is what sometimes the ICAI said. Finally, I think 2 small points I thought I should tell all of you all. I think all of you all know this. I will still repeat it, but mistakes cannot be eliminated. Don't. Only minimize those mistakes. And I've always felt that if the same mistake is repeated, it becomes a decision. It means you made a decision to make that mistake purposely. in this entire discussion on non-corporate enterprises, please remember a couple of things, which is that this is something which is not new to all of us. This is not like Ind AS or US GAAP or something. This is what we already know. There are only amendments to a few standards and a few disclosure requirements from what we already know. That is why I am saying that take this as a one-time exercise. Use this guidance note for the purpose of presenting this, because the institute does not have the power to do a Schedule 3 for non-corporate enterprises. They cannot do it because they don't have the power. They are not authorized to do it, unless they have done it by this time. They can only give you a guidance note. So it becomes an opportunity for all of us. Please remember this, that even if you have got, let us say, 5 non-corporate clients among your client list, even among them, if you want uniformity, you can follow this format. As I said, the numbers can change, the figures can change, individual accounting policies can change, but at least you've got commonality as far as the format is concerned. I think if all of you make a start, it will really be a good thing, and the institute will be the most happy person, probably be the institute themselves. Thank you very much for the patient hearing. Any questions I take? Thank you.
Yeah, dear members, before we give the vote of thanks, I have an announcement to make for you. On 27th tomorrow we have AS 200, a half-day program, and on 28th we have a full-day program on global taxation. Yeah. On 8th, all women members, please be alert. We have a women's conference on 8th. So kindly tell your friends to get themselves registered for the program. Yeah. So hope the members have taken the full advantage of today's deliberation by the speaker. May I call upon Chairman sir to please hand over a token of appreciation and gratitude to the speaker sir. May I have a kind of round of applause? Thank you one and all. Wish you again a happy Shivratri.